So welcome to my video introductions to the capstone simulation. So in the introduction video, we took a brief look at the capstone courier. So this video will devote to analyzing the courier in detail. So the courier is an industry report, and there's a courier for every round of the simulation. So as the simulation progresses, there's a new report that's released that details the financial results of the previous round's competition. This would be like a trade journal in an actual business environment. So the first thing right away you notice in the courier is there are selected financial statistics. So in public companies of sufficient size, the companies issue quarterly results. You get quarterly financial results that are publicly available. So your competitors will have financial information released that you have access to, and that's the same in the simulation. So these are the financial results from 6 different businesses in the sensor segment in this simulation. And right away, you can observe that there are some pretty significant differences between the teams. Some teams have much larger sales, for example, than others, and some companies have a better profit structure, and so and have greater accumulated profits. This first screen highlights important financial metrics that are relevant to assessing the performance of your business. So the first is return on sales. So return on sales is defined as earnings, accounting earnings divided by sales. So a higher return on sales means that you are getting more earnings per dollar of sale. So it's like a profit margin, but it incorporates more expenses than just a gross margin would. So this is accounting earnings should be capturing actual value creation. So it's a measure of value creation per dollar of sale. If return on sales is high, then there's a lot of economic value generated per dollar of sale. And if it's low or negative, then economic value is destroyed. So, for example, Chester in this case has a negative return on sales, which means if they were to, say, find a method to increase sales, that would actually cause them to be in worse financial trouble unless they were to do a restructuring of their production first. Asset turnover. Asset turnover is sales divided by total assets. It's a measure of how effective the company is at turning the fixed assets of the firm into sales. So if you have a lot of idle factories, your asset turnover will hurt. If you have a ton of folks working overtime, then you'll have better asset turnover, but perhaps slightly higher variable costs. A return on assets is net income divided by total assets. So that's a measure of how much economic value you're generating per dollar of fixed assets. So naturally, if you have a high asset turnover, that's going to help your return on assets, assuming your sales are generating net income. Leverage is assets over equity. It's a measure of how much debt actually is in the financing structure of the firm, since all assets are either pledged to the stockholders or to debt holders. So the higher the leverage ratio, the more of the firm is financed by debt. A return on equity is like return on assets and return on sales, but it's scaled by the equity of the firm. Return on equity differs from return on assets in that return on equity can improve by increasing leverage. Emergency loan is if over the course of the previous year, your company ran out of cash and had to do emergency financing. Well-run companies don't have emergency loans unless they were forced to have them by strategic behavior of their competitors. But through neglect or lack of foresight, it's easy to get them as well. Sales are as you'd expect. EBIT is earnings before interest and tax. That is it's a measure of operating profitability. So it doesn't take into account gradual decline in the value of the company's assets, for example, but it does take into account operational expenses and interest and tax. Profits were the raw profit earned by the firm in that period. Cumulative profit is the same as profit, but accumulated over the course of the simulation. SG&A is sales, general, and administrative. So these are fixed expenses incurred by the firm in selling their products. Since we're dividing by sales, a high number here means we spend a large proportion of our revenue on fixed expenses. A low number would mean a low proportion on fixed expenses. So naturally, we want SG&A divided by sales to be low. And contribution margin represents the percent of the product that can contribute to the overall benefit for the firm. So higher contribution margin is better, and generally you want to be above the 30% range unless your strategy happens to necessitate a smaller margin. But so there are strategies you can pursue that make your margins lower. But if you're not pursuing a low margin strategy and are trying to pursue a high margin strategy, but only achieving low margins, then there's something structurally wrong in how you've structured your business. So these key financial statistics are a great way for a manager of a business to assess where operational improvements might be made, and so that's a great example of how financial analysis, even though it's strictly finance and not necessarily management, provides information that is vital to informing management decisions. So much so that distinguishing the two can be splitting hairs at times. So that's the introduction to the financial statistics. Coming back with the next video, we'll take a look at some of the product by product information.